Hello everyone, welcome to the Grow Your Future podcast. I am Zah, your host, and I'm joined by the best accountant in the world, Sam.
Shucks. Thanks, mate. How are ya?
Just on that, being the best accountant in the world, specializing in property investment.
Yes.
How long have you been doing that for?
Been doing it for about 12 years now. 12 years. So obviously didn't start at the property accounting level, but I went through the years developing knowledge in all different facets of tax and then specialized in property for about 7 years or so. And what that means is that, like you advise people in property where to put it, or where to put your money in property, I can help people in a complementary way of how you'd structure that, in what kind of entity, who should buy it, are you exposed in business, should we get in trust, should we do it through super, blah, blah, blah. So, complementary thing, and yeah, been about 7 years helping people invest in property and just coming from a tax perspective, really.
And there's not many of you around, is there, Sam? When it comes to, like, there's a lot of accountants, obviously, there's so many. There's an oversupply of accountants.
There's too many.
But the ones that actually specialize in property investment, and this is not your own home, we're talking about investing.
Yeah.
There's actually not that many that actually specialize in it, is it?
No, not really. Not really. It's a bit of a niche. It's sort of a good niche, because a lot of people, to help reduce your tax, property is one of the main things, a main strategy in helping reduce tax. So it's, like I said before, it's very complementary with property. Helping people all the time.
Because when you think about it, property investment is a numbers game, right? It's not really so much about the property. It's more about the finance behind it, and the yields and the returns and the tax breaks, all of that sort of thing. Yeah. So it is actually really important, if you are a property investor, to have people on your team, not just accountants, but also lawyers, solicitors, conveyancers, who specialise in property investment. And the reason why I've just opened up our podcast on that is that we're going to go through some stats, right? Oh, first of all, what this podcast is about is the 10-year acquisition strategy, right? Now, the 10-year acquisition strategy is our signature model here at Luxland, and what we're going to do is we're going to talk about this strategy. But going back to having people on your team that are specialised in property investment, and the reason why there's only a small minority of people who specialise in investing in property is because, let's go over the stats, right? There's only 2 million people, of the 26 million or so people that live here in Australia, that own one or more investment property. Only 2 million.
Yeah, not many.
Out of the total population. Now, 20,000 of those 2 million own 6 or more. So it's less than 1% of investors. So let's think about that. We've got 26 million people that live in this country, which is not really a lot, right? But it's still a lot of people. 20,000 of those 26 million have 6 or more. Now, with our acquisition strategy, we're trying to push people to go to 10, right? But realistically, if you've got 5 to 6 really good investment properties, you will achieve financial freedom, in time. But only 20,000 people are doing it, right?
It's funny. I think, from a tax point of view, I'll always come back to that sort of side of things. Whenever a client comes to me saying they have a tax issue, there's always that option of property. There's a few other options, super and things like that, but a main one that's very effective is property. So it's surprising that not more people are doing it. It's puzzling. We're trying to help people get into that space. That's what this is all about, because we do really see the benefit of it. And if you partner with people that can help, pick the right property, and accountants that know property to help you not make mistakes. For example, land tax issues you could avoid. And some sort of planning around sales and potential refinancing and all that kind of stuff, you're going to do really well. So, very surprising numbers. I guess we're here to buck that trend and help people get in. It's going to benefit them. We're here to help.
Okay, so the 10 properties in 10 years, Sam. We've heard about it a lot. We read it in newspapers. Sometimes people have more than 10, right? But a lot of these companies out there, they spruik the 10 properties in 10 years or shoot for 10 properties and you'll achieve financial freedom.
Yeah.
And I think the reason why we do it is because even if you don't get to 10, at least even if you get halfway, you are actually on the road to financial freedom. And I think the reason why we push this 10 in 10 years is because we're putting a bit of a deadline on it, right? Like a lot of people won't do it, right? And a lot of people will take maybe 20 years to do it. But at least it's a rough guideline of setting yourself a target and going, look, let's try and buy a property once a year or once every 2 years and really get to that point. There's going to be a point in that strategy where you will go, no more. You don't need to go anymore. And look, everybody's needs and wants are different, but if you shoot for that from a very early age, like you're going to guarantee that life's going to be easier further down the track, right?
The word target is very important in that whole sentence you said. What the 10-year acquisition strategy is your target. Like you said, you may not achieve it, but it's something that you're working towards, and it's going to propel you to act. That's what it's all about. It's getting you to act and do something. So hopefully we achieve it, and we'll do our best to help you do that. But like you said, not everyone will achieve it. Life happens, families happen, things go astray, all that kind of thing. But if you're on that path and looking to really chase that goal, then it's going to benefit you.
So our goal, Sam, is to get people into that 1% club. We call it the 1% club, right? Where you own 5, 6 or more properties, and you're set. And we've got people who do it, but before they turn 30.
Yeah.
And all they've got to do is hold on to dear life, let those assets mature over time, pay themselves off, and then hey, they've got their retirement fund there. And that portfolio that they build early on just takes a life on its own, and it just keeps growing and growing and growing. And our goal is to get as many people into that 1% club as possible. So what we're going to talk about today in this podcast is basically a presentation on how it works, right? So let's just go with the first step. The first step would be to identify goals and objectives of that particular client, right? So that individual is going to be different to everybody else. And I guess that's what we're qualified to do in giving that advice, because everyone's got a different tax position. Everyone's got a different deposit size. Everyone's got a different job. Everyone's at a different age. And it's so variable, isn't it?
Yeah. It goes back to identifying what we're trying to achieve. Like you said, everyone's different. Everyone has like the 10-year acquisition strategy is the path, but everyone has different goals within that path and different things they're trying to achieve. So really, you have to differentiate between people and come up with something that's customized, because one shoe doesn't fit all, especially when it comes to money. There's a lot of extenuating circumstances like inheritance money, different levels of income, spouses, child support, heaps of different stuff. So when it comes to formulating some sort of plan, you have to take all that into account.
So, things like borrowing capacity, like the list goes on,
heaps
right?
of
And it's really, really important. And the reason why we talk about this is because when we're getting clients in front of us, what they normally do is they come to us and they say, Zah, I've been on realestate.com and this is what I'm thinking I want to buy. And it's like, well, have we assessed your position? Have we assessed what your capacity is? Have we assessed your goals and objectives? What do you want out of this?
That's right.
And the problem what people have is that they focus on the property first and the investment second, when the investment needs to be first, the numbers need to be first. So what we need to do is go, right, let's get to know the client. So the first step is to get to know the individual. Right? So the individual is going to have different needs and wants, and also different borrowing capacities and all of that sort of thing, right? But what we've got to assess really is, what do they want out of the purpose of property. Like the property is just a vehicle to get them somewhere, right? So really, at the end of the day, when we're talking investment property, you're not going to live in it. It's really unemotional. We need to be able to figure out, okay, this property that we're going to invest in, where is it going to get to us? Is it going to get us to a second one and a third one and a fourth one and a fifth one? Or is it just going to get us into our dream home, you know, as our second or third purchase? And everybody's going to have different objectives. So we need to assess that from the beginning because it will affect our recommendations, right? So one of the biggest questions is the asset types and what ratio do the asset types play in the acquisition strategy. So it's between apartments, townhouses and houses, right, Sam?
Yeah, and based on what you're saying, really what the answer is it could be anything because it really depends on the person who's involved. So really that's when it comes down to the advisor working out your situation, working out where you want to get to, and then formulating the plan. So the mix can start at an apartment. It could start at a house and land package, depending on your numbers, depending what you want to do. So really that answer is customized to the person. That's why you need to talk to us.
And this is the problem with when you're recommending stuff to clients, right? They go home and they talk to other people about these investments that they're about to make, and these other people go, "Oh, that's a shit investment. Why would you invest in that?" And they're only looking at that one property, right? What we've got to understand is that it's a 10-year acquisition strategy. It's not the only property. It's one piece of the puzzle.
That's right.
So, and what suits that person is going to be different to the next person. And this is the issue. I've actually had this issue this week where I've recommended properties to clients. I've spent so much time with them and they've just turned around and gone, "Oh, I've spoken to my dad and he reckons I should buy something out at Granville or whatever." It's like, "Oh, I should buy the next door neighbour's house." You know what I mean?
Why do they even come and talk to you?
Well, obviously they want an answer, but the problem is that mum and dad or their uncle or whoever's recommending this alternative option isn't taking into account the whole strategy. They're looking at the property in front of them, right? And that's why it's really important to get this mix right and understand each asset type. So apartments, townhouses and houses, we need to understand, okay, they have a different purpose. Each one will serve a purpose, but a different purpose. Okay. So let's start with apartments. Apartments are generally great for yields, right?
Yeah, so you're entering in a relatively speaking amongst the other assets at a lower price point, but the rents you're getting on that are quite high compared to the price point. So it's generally a good property to get if you're looking for that heightened cash flow. There could be limits in other areas, potentially capital growth and things like that. So apartments, if you're picking well, you can still get the growth, but it might take longer to occur.
What I like about apartments is it allows you to get into really good locations, which you probably sometimes might not be able to get into like a house and land. So for example, we're doing a bit of investing in Essendon of Melbourne. Like you can get an apartment there for 450 grand, right? Wow. But the median house price is 1.5, 1.6 million, right? So, as an investment, it doesn't make sense to buy a house there, but, the yields and, the location play works really, really well there in the apartment space.
Sorry, just quickly, for our listeners, why would, in that specific example, with that lower price point for the apartment and the massive difference between the house and land, why would you recommend putting some money into that market? Well, what's there?
It's a very good question, Sam, because right now we're seeing a massive boom in house prices. Like houses are going through the roof, but apartments haven't really moved, right? And what generally happens with the property cycle is that the houses will go first. Everybody wants to live in, get the land and big house, and especially now with COVID, they're really sort of valuing their space. But what will happen eventually is that people can't afford the houses because they're just too expensive.
They get too out of reach.
Like we're going to see double-digit growth this year. Like it is crazy what's happening in the marketplace. Now people still want to live in those locations. So let's take Essendon for example. A house is 1.6, and that's for a shit box, right? So a good house will cost you about 2 mil, right? And an okay house will cost you 2 mil. Now those people that don't have 2 million to spend, but they might have 800 grand. They could maybe buy a townhouse or an apartment, right?
Yep.
And they can stay in the suburb, their kids can still go to school, their families are still there, and that's just what happens. And then those, that gap between apartments and houses will tighten.
Will close.
Yeah.
Okay, so you're capitalising on the flow of funds from a house and land that's out of reach for people to the demand going to apartments because they're now affordable. So if you get in at the right price point, you're going to get some growth.
That's correct. Okay. And a lot of people are seeing apartments not grow right now, and they're going, no, they're a shit asset.
Yep.
We need to be investing in houses.
Yep.
No, actually, you won't be saying that once it catches up.
Okay.
Once it catches up, what's going to happen is people are going to go, damn, I should have bought an apartment.
Yeah.
Do you know what I mean?
No.
You want to get in before it starts to boom, right? Like, buying houses right now, like it's quite hard.
Yeah.
It is very hard because there is so much competition.
So much demand.
Yes, it's growing, but you are overpaying, right? Like you need to be very, very smart with your buying if you're buying houses. But apartments, you've got a little bit more choice, right? Because the majority of the population who are investing aren't looking at apartments right now because investors aren't really in the market right now. We're a small minority of the buying population. So you need to be able to forecast where these prices are going. And this is where the opportunity is because you got to think about it. There's quite a few apartments on the market at the moment which are really good buys, but there's no houses that are really good buys. So you want to buy, you want to think with a long-term mindset, 20, 30, 40 years, right? In 20, 30, 40 years, are you going to look back and go, man, I should have bought an apartment while I could, right? So they are great assets when you're adding it to your acquisition strategy.
Yeah, so it's going to be an important mix of your portfolio, depending when you buy it, is dictated to by your circumstances. So long story short of apartments is they have their place, right?
Yep.
They have their place. If you pick well, it always comes back to picking well, which we'll touch on how you pick well later. But obviously no apartment, or all apartments aren't equal. You have to really drill down, and even to the floor plans, which I've seen when analysing properties with yourself, with clients, which I've never seen before, down to the nitty-gritty of how the kitchen is laid out can have a potential impact on the value down the track, which is very interesting.
Well, resale is very important, and we want to make sure that we can impress the valuers when they go in and when we refinance this property. But I guess, you know, there's some really good value in apartments at the moment, really good value. But what we've also got to understand is apartments are great to just throw in to the acquisition strategy because they cash flow really well and it exposes you to more real estate. So for example, if your portfolio is worth $2.5–3 million, and look, you want to expose yourself to maybe another $500,000 of real estate. It's quite easy to do with apartments because you know it's cash flow. You know it will yield. So all of a sudden you've gone from $2.5–3 million worth of real estate to 3.5, right? And it's a free property because usually apartments pay for themselves. So they're a really good play to just beef up your portfolio. A lot of people do it on the tail end, but it's also a really good affordable price point to get into.
So it could be like a stocking filler.
Yeah.
So it's not your main presence, but they're there to sweeten the deal.
Yeah,
or something like
it complements
that.
it,
Complements
right?
it, yeah.
Let's move on to the townhouse. So basically a townhouse gives you the best of both worlds. That, you know,
In what way? In what way is that?
So you get the benefits of the yields that you get from, say, an apartment because you're in quite a good location, but you also get that land content, right? With that proximity to, say, infrastructure like CBD or the water, or whatever it is that you're trying to be close to. Sometimes people can't afford a house in that location, so they'll settle for a townhouse. They call the townhouse the missing middle. Where, you know, it's the middle, where it's not an apartment, it's not a house, but it's that middle ground, right? And they're gaining really, really good popularity right now because what's happening is people don't want the massive backyard anymore, the high maintenance. They don't mind spending maybe $50 a week in strata to have their, you know, landscaping maintained and all of that sort of thing. And it provides a little bit more of a community because you're living closer together. And I think people are learning to live quite efficiently now.
Okay. With that increased demand for a townhouse, is that coming from your experience and your knowledge in the market? Is that coming from investors or like potential homeowners or both? Is there a lot of investor activity in that market as well?
Look, I think there could be more investor activity. Usually what happens with townhouses, for example, they're sold off the plan, right? And when they're sold off the plan, they're targeted towards investors because owner-occupiers can't really touch and feel an off-the-plan product.
I see.
So what developers do is they discount their products to sell off the plan so they can get the pre-sale, so they can get the construction finance to build the project.
I see. Yep.
So what they do is they target investors like us and they say, look, we'll give you a discount, right? We'll sell it to you cheap, buy it, right? Take advantage of the yields and the tax breaks because it's brand new. Then generally what happens after 3, 4, 5, 6 years, those investors take advantage of the depreciation and then they sell it to an owner-occupier because now owner-occupiers suddenly...
They can touch it.
Can touch and feel it.
They can see it.
Right? They can get emotionally attached and they can go, oh, hang on, I can view myself living here. But buying off the plan as an owner-occupier is very, very difficult because you can't visualize it. It's very, very hard to.
Yeah, and when you're a homeowner, you're wanting to move in straight away, really. So I guess that's showing that the investor market is the one pushing that demand there in the townhouse space. Because you're getting the snippet of land, which is cheaper than buying the house and land. Right?
But the problem we're finding at the moment, Sam, is that there are no projects. There's a shortage of this type of stock. Now, what happens when there's a shortage of stock? Prices go up.
More demand than supply, it's always going to go up.
So townhouses at the moment, if you have one or if you're in contract for one, you're going to do very, very well in the right locations.
Yeah, it's always boiling down to that actual point, really. So it's not every townhouse is equal, like we've said. Every asset is not equal. You have to really drill down and pick the right ones to perform.
I actually love townhouses because, especially the ones in Brisbane, right? Because in Brisbane, townhouses are made almost like houses.
Yep.
They're like 160, 170
big
squares.
Places, eh? Yeah.
You know,
big
for a
places.
3-bedroom townhouse being 170 squares internal living space, it's quite large. Like we build sometimes houses about that same size, right? So you can buy a townhouse, you know, and for an affordable price point.
Yep.
And if you let's say you want to rent it out, you can get a good yield from it. But let's say you wanted to live there, you can live quite close to, say, the CBD, rather than going out to the sticks trying to build a 4-bedroom home, and you know, just because you want that 500 square metre block of land. You know, I would rather be closer to a location where my life is.
Would you agree that, different to the apartment, would you say that townhouses would demand more a homeowner after that 5-year brand new period? So it would drive a bit more growth to a townhouse property than, say, an apartment. Would you agree with that?
I completely agree. So with compared to an apartment, generally apartments are targeted by investors because they can get the yields and people really do aspire to live in the bigger property. So if you had to compare it to an apartment, the townhouse would be driven by more owner-occupiers, meaning that you would get that capital growth on the back end eventually. So yeah, because of that land content and that proximity to the CBD, it's just a really good investment, right?
So it sounds like the most balanced type of investment to do. You're going to get a good sort of yield, and there's a potential for the capital growth that maybe an apartment won't achieve for maybe just a slightly more pricier price point.
Well, look, let's compare it. Okay, we've compared it to apartments. Let's compare it to a house, right? So let's say you've got a townhouse that's worth $550,000 and it's, say, 10 k's from the Brisbane CBD, right? Or you could build a house, right, on a block of land for the same price, 30 k's from the Brisbane CBD. Now, me, as an owner-occupier, I will fight for that townhouse, right? Because think about it. What are you actually going to get by going all the way out 30, 35 k's from the Brisbane CBD? What more are you going to get?
Bigger commute. Or with COVID, who knows? But they're not really. You're not going to get too much, not convenience. There's no convenience. There's not going to be, I guess, a demand for that area down the track because it is further away. So you're sort of getting an inferior location, would you say?
Yep.
Yeah.
Less desirable.
Less desirable.
Less desirable, to be nice about it. But it's not all doom and gloom for houses, right? So let's move on to house and land. Now, if your budget allows, let's call it 750 plus, 700, 750 plus for a house and land, then obviously you're going to be able to get into a better location, right? So that's where I would say, okay, yeah, maybe we do the house and land. So this is the thing, location's always number one.
Yep.
So a lot of people, they'll sacrifice on that location, right? Just because they want to build a house and land, and they'll do it out in the sticks, and they wonder why in 5-10 years time their property hasn't grown by much.
Yeah.
Because their land content and their positioning is less desirable than, say, that townhouse, right? But once you get into that 750k plus price range, then house and land is actually the holy grail of building wealth, because it's those big chunks of equity on the back end because of that scarce land supply, especially in those landlocked areas where you just cannot get any more land. That's just going to grow in value. Like, that's making money in your sleep.
Yeah, it's coming back again to picking where you're putting your money. So whether it's the apartment, townhouse, or the home, house and land, it's really where you pick that's going to achieve or help you achieve your goals, whatever those goals were. So really it comes down to be very picky, listening to people that know what they're doing. Like you just mentioned about the house and land play, landlocked areas. So when we see clients coming in, depending on their price point, they might want the house and land, but look at is it called a green fill area? That might
Unlimited supply.
Unlimited supply. So they're attracted to get the house and land, which everyone knows is the holy grail. But this green fill or this unlimited amount of land where they're investing is not going to really give them some value down the track. So all houses aren't the same.
Sam, it's a healthy balance, right? Like there's you can go further out and still get value, but if you're in a market where it's heavily oversupplied, then that capital growth is going to take a long time before you see it. So that's why it's really important to understand each asset type and what purpose they can provide in the acquisition strategy, because each property will do a different thing, right? Normally what happens is that we try and push people to house and land, like quality house and land at the beginning stages of their acquisition strategy. Why? Because we want to get that capital growth to launch them into more properties as the second, third one, fourth one comes along. But unfortunately, sometimes people just can't do it, right? And you've just got to accept those are the cards that you've been dealt.
And that's why there's the other options, right? So when clients come in to see us, we generally would go through what they want to achieve, which is usually getting ahead, building some sort of wealth behind them that they didn't have from their family. And then we assess them in terms of what can they actually do, their price point they can achieve. That's going to dictate really where they're going to put their money. How much you can borrow, how much deposit you have, how much income you're generating is going to dictate your price point, which is then going to allow yourself and other people in the advice industry to tell you this is what you should do with your money based on your price point. If you got $500,000, you shouldn't buy a house and land, right? Based on what we're talking about, it's not going to do the best return on your money. You want to do maybe an apartment. So really, it's going back to the fact about what we talked about at the start. It's all different. Depending on your situation, will dictate what you're actually going to put your money into. And
this is the thing, Sam. People get recommended, say, an apartment, and they'll go back and they'll talk to their spouse or their parents or, their friend at work who has no fucking property at all. And then all of a sudden, they've got in their minds that they've bought a really bad asset, right? Yes. But the problem is they're failing to see the whole plan, the roadmap, the acquisition strategy, which is so important. It's only 10%. That one property, when you think about it, is 10% piece of that 100% puzzle. So we got to think, okay, the cards we've been dealt are our incomes, our deposit, our borrowing capacity, our age, our line of work, whatever it is, right? And then we've got to go, okay, well, what can we do to build this acquisition strategy, to build this massive portfolio? It may just be an apartment, or it might be a very big house and land which costs $1 million because you've got the capacity to do it. But you should do it, right? Because we're focused now on the purpose of each asset rather than the asset itself. That's right. Right? We're not thinking, okay, well, what color is it, and can I picture myself living here one day?
They're getting emotionally involved, yes, which is incorrect. It's a money decision. It's an investment decision. It all comes back to numbers, which is what we assess everything on. We look at you as pretty much a business, your numbers, and we're looking at the property as numbers, and we marry you up. That's it.
That's right. So how do we back it, Sam? How do we back these asset types? So we've got these things called the fundamentals, right? Now, before today, we had 5 fundamentals. So we've got an exciting announcement to make. We actually have added one more fundamental to our very famous 5 Luxland fundamentals.
What is it?
But we're going to go through number 1 to 5 first, right? Hold up, Sam.
All right,
we're going to go through number 1.
I was a bit excited because it relates to me a little bit.
It is very exciting. So we're going to go through number 1 to 5 first, and then we're going to reveal the 6th one at the end.
All right.
So number 1.
Probably the most important. It's number 1 for a reason, and it really goes back to the choice of the property. It's not the property itself. Sometimes it's where it is, and it's location. Location is always going to be a very fundamental driver of value, whether that's the rental yield you're getting, or the capital growth over time. You want to be buying where people want to live. Really, that's driving demand. So if you're buying out in the sticks where you don't see anything going to happen, are people going to be wanting to live there in the future? Do people want to put their money there? So really you're looking at location as a founding or one of the most important points of where you're putting your money.
We've all heard the phrase, location, location, location.
There's a reason.
And I think people focus on, again, the property itself too much.
Yes.
They think, for example, I can get a 4-bedroom home on a 600 square metre block for $500,000. But what they don't understand is the location is going to do the majority of the heavy lifting when it comes to capital growth. Like, I would much rather be in a better location and buy an apartment or a townhouse than buy a house in the sticks in an inferior location where I know it's not going to grow. Like, realistically, all we're wanting is that land, because that land is going to appreciate in value rather than the building itself. The building actually depreciates in value. So location is number 1. Like, it's a non-negotiable. It has to be a great location. That's why when people come to me, I had a guy come to me during the week and he goes, so I've been offered from another company a house and land package for $450,000, right?
Wow.
And it was in the worst location. Like, if you look at the stats on this area, the incomes was so low, I think JobKeeper, the people on JobKeeper get paid more, right? So and nothing against people in that area. I'm not going to say it because I don't want to degrade them. But
no, it's just an example.
It's an example of where we don't want to put our money, right? I would rather that guy spend $450,000 in a 10 out of 10 location, but buy an apartment. Sure, he's not going to get that solid capital growth from a house and land, but he'll probably get more capital growth than the house and land in the sticks.
How many times have you seen a piece of shit house in a mad spot go for ridiculous money? In Sydney, you see it all the time. In the CBD areas, just an example.
We read about it on the news every day.
Like a toilet block will go for $3 million. You're like, what? Car spaces are getting hammered.
And that's because of the location.
It's all about location. So that's why it's the number 1 point. When we're analysing properties for clients, we're always looking at location as being, where can we put this $500,000, whatever your budget is, in the best location? Then other things come after.
So it doesn't matter what market we're dealing with, whether it's Queensland, Victoria, New South Wales, whatever, right? We want to know that the location is, got a high affluence score, it's got a high suburb score, it's got their weekly family incomes are way above the state average, rental yields are strong, all of that sort of stuff, right? And that plays into the location. And we can look at that data.
It's all numbers. It's all data. That's why it's coming back to investment. You're looking at numbers. If the numbers all stack up for that location, it's going to be a winner.
Numbers don't lie.
That's it.
Number two fundamental is the builder/developer. So whether it doesn't matter if you're dealing with an established property or a new build, you want to make sure that it's been built by a credible company. And that doesn't mean it has to be a company like a massive company. It just needs to be a quality build. It just means that, you know, we're not going to have these long-term problems like a lot of these other dodgy developers have done in Sydney, for example, with these buildings that are cracking and, you know, everyone has to evacuate and you can't find the developers anymore. They've done the runner.
They do a Phoenix company. They shut the company down, run away, start a new one, do it again. So you have to be very wary.
Bad.
Very wary. I had a close colleague I was working with about 5 years ago, just to point out the potential mishap you can have when you're investing in an inferior developer. He wasn't to know. It was I think it was a relatively new developer. They didn't have much track record, which is probably a bad sign as well. They're new. They could have been a Phoenix company or something like that.
Well, you never know.
You never know. There's no track record, right? So he, you know, wanted to put his money. He actually bought his home, which was an apartment in DY, brand new. I think it was off the plan. So he put his money down. Developer looked all good. They built the property. Blah blah blah. It came back when he moved in that the air conditioning systems on the roof were placed illegally per council requirements or something like that. It was blocking the view of other neighbours. And that wasn't even in part of the plan. So the developer and builder combination put things in the wrong spots. Also part of the build, there was some shonky work in the garage where it was flooding. The garage door was broken after like 3 months. There was flooding inside his actual apartment from the balcony. It wasn't leveled and going to a drain or something like that. So he made a very big investment. It was about $800,000. And he got to the point where he couldn't sleep at night because he had all these expenses coming through because the developer had then disappeared after that.
He'd done the runner.
They've done the runner. So massive lesson. He's stuck now with that property. It's probably not worth as much as he paid for it due to all these issues. And the owners are now liable because it's gone away from the developer and they don't know what to do.
And this is why we have a business, Sam. I actually had an accountant call me yesterday on behalf of a mutual client trying to figure out what we did here at Luxland. And because he wanted to, you know, be sure that he was recommending a good service to a client that's inquired. And I basically said to him, I go, look, our goal is not just to make our clients money. I mean, that's a big goal of ours, and it's, you know, it's a driving force behind what we do. But it's also to stop our clients from losing money, because we've got to think about it. Real estate's really easy to get into. Anyone can buy an apartment off the plan. As long as you've got the money, you can, right? Now, when you encounter problems like that DY problem, where, you know, like you're tearing up cash. And it's a big investment. And if you were trying to sell that, good luck, right? So it's really important to know that if you're going to get into an asset, yes, the location is important. We've harped on about that for a while. But the builder / developer, you want to be part of a build which has been upheld by a brand, by a reputation, because you can call on those people, even if it's past the 6-year structural warranty, and you can know that they're going to go, you know what, we're going to help you, right? You want people with a really good track record that have been in the game for a while. Don't deal with anyone that is just backyard and you've never heard of them before. And this is the problem, Sam. So many uneducated people get sucked into these marketing campaigns, these sleek marketing campaigns, and they're left with an inferior product.
I think another factor to consider is when you're dealing with a good developer, a branded developer, you might be paying a little bit more for that product, but in the end, you're going to save. My friend, my old colleague, he right now, in hindsight, he would love to pay a bit more to get a better developer or be in a better development than having this ongoing long-term issue, which is probably unresolvable. So it's worth paying that extra bit of money from the get-go to be in a product that's built by a reputable brand.
And we're big on that, Sam. Like, we're not big on, you know, we don't find bargains. That's the thing. A lot of people come to us and go, oh, Zad, I thought you were going to get me a deal. And it's like, well, no. Bargains are a bargain for a reason, right?
That's right.
Builds are cheap for a reason. We actually specialise in overpaying because we know that if we overpay, let's say $50,000 for a build, in 10, 20, 30 years' time, you're going to be glad you paid that $50,000 premium. You know what I mean?
Yeah.
Like, you want that to last. You want to be in a position, 20, 30 years' time, you've got a problem, you can call that builder for some advice and some help.
They're still around.
They're still around,
They're still
man.
building developments.
They haven't done a runner.
They're not falling down.
They're not a phoenix. Let's move to the third one. Supply and demand.
Oh, going back to economic principles, okay? Very simple. So if you're looking to park your money, after you've found the location, after you've got a good builder or a developer, you really need to look at what's in the market, what's not in the market probably is more important, and really put your money into something that is a less of supply, that will create an automatic demand for it.
It's like anything, right?
Anything, it's normal.
When you've got a low supply of something, in anything, it could be gold, silver, any type of commodity, some type of asset. Even last year, we had a low supply of used cars, right? So a low supply of used cars, it pushed everything up, right? I think my truck went from 80 grand to 120 grand overnight, right? Because they were making no more of them. They weren't bringing any more in. And all of a sudden, it just pushed up the prices of everything, really. So it's, it's that low supply market that you really want to be investing your cash in. So, for example, we live out at Alexandria Way. We rent there. There are thousands of apartments going up. And, I don't think as an investment you should buy there because, there's an oversupply of apartments. And they're still building more and they're only going up, right? Where you want to buy in a very tightly held market where there's a lack of supply and prices are only going to get pushed up. Emotional buyers are just going to keep buying, paying more. So we've all seen the auctions where people are emotionally invested into these properties because there's no supply, and you've got 100 people bidding on the one property and paying 100 grand more, 200 grand more. They're the properties you want to invest in.
And it really does touch on the previous 2 points, because location, if you're able to find the location, like we said, the infill where there's no other land, you're automatically creating a demand because there's no other land, there's no supply. And again, with the builder developer, if you are able to get into, we were lucky enough to get into some good developments with some pretty big branded builders and developers. They can't make everything forever. They have a finite amount of time they're going to be building things. They have a certain amount of resources they can deploy. And if you can get into these good branded developments, there's only going to be a certain amount of them made over time, and you could really have a winner there. So that supply and demand in and of itself as a topic actually applies to the previous points.
That's a really good point, Sam, because one of the developers that we recently worked with has now gone out of the investment space.
Really?
And they are probably one of the best developers in the country. They're actually publicly listed. They are so strong in the marketplace, and for my clients that were fortunate enough to get into that market, and including myself, I bought one there myself, and we're not going to get an investment from those guys anymore. They've moved on to higher end stuff. Their minimum buy-in now is like 1.2, 1.3 million. So as an investment, we want to be spending 600, 700,000. They don't have that product anymore. So now what's happened is they've stripped that supply. We've got the brand name, right, from a world-class developer as an investment. That's only going to go up in price. So that's a really good example.
No more supply only equals more demand. Perfect.
Number 4.
What's number 4? Stage of the cycle.
So property cycles, they go in waves, right? And basically, what we want to look for is where the opportunity is. So where is the opportunity right now? And generally, it's where the affordable market is, because investors are looking at value for money. Owner-occupiers are also looking for value for money when you think about it. And they're also looking at lifestyle. So they're going to go, okay, well, where can we go and get good value for money but live a really good lifestyle? So right now, Melbourne and Sydney are almost on par with each other, but apartments in Melbourne and townhouses are still relatively affordable. It's slightly behind Sydney. So a lot of people who love the Sydney market and, missed out on that that Sydney boom that we just had, there's opportunity in Melbourne right now. There's affordability there. You can get so close to the Melbourne CBD and buy an apartment for 450 grand.
Why do you think people might shy away from doing that? So it makes sense as an investor, but do you think because it's interstate, they can't, it might be a bit daunting for them to invest outside their area?
What's funny about us Sydney-siders is that we've seen the boom in Sydney and we think Sydney will never fail and it will just keep going up here. And there's so much demand in Sydney, right? But the problem is there's no affordability here anymore. It's so expensive, you know, like $2 million doesn't really buy you much in Sydney. It doesn't, and it's the truth, right? So, and there's not much more room, like wages haven't grown. I mean, Sydney will always grow, but as an investment vehicle, it's quite hard because the yields are very low. And this is the thing, I'll recommend something in Brisbane, and then someone will come back and go, why wouldn't I just buy in Sydney? Sydney will never fail. And so, well, can you afford to hold the asset?
That's right.
Can you afford to hold the asset in Sydney? So Sydney yields are very low. There's a lack of affordability. Where is the opportunity? And that's where we go, okay, well, Melbourne is about 5-6 years behind Sydney.
Yep.
So apartments and townhouses haven't really gone through the roof. That's where the affordability is. That's where the yields are. We should be parking our money there. Brisbane, you know, townhouses and houses, great affordability. You can buy something for $1 million in Brisbane, be 4 or 5 Ks from the Brisbane CBD. You can get $1,000 a week in rent. Like, it's a dream come true for an investor, right? Now, you've got to also, you also got to take note is where is the migration going to? Right now, net migration is all going to, basically majority is going to Queensland, right? They're going to southeast Queensland, and because that's where the affordability is.
No one can buy a house here.
That's where the lifestyle is. They like the weather. They can sell their $3 million asset here, buy a $1 million asset up there, and keep $2 million tax-free, for example.
Would you do it? I'd probably do it.
Look, it's tempting. Like, I think I'm not in the right stage of my life right now to do that, but imagine all the other people.
It makes sense.
They're in their 40s, they're in their 50s, they're thinking, you know what? Sydney's too expensive. Fuck this place. I'm going up north, right, to the sunshine.
Oh, it sounds very tempting. It comes back to getting bang for buck. So really stage of the cycle, you're looking at where can I put the money to work as hard.
I love that, bang for buck.
That's what we're looking for. We're looking at numbers. It's all a numbers game. And it just doesn't make sense when we get clients coming in with their own, they can have their own theories, but once you go through these things with them, they shouldn't be looking at Sydney and all these overpriced markets to really get bang for buck because there's none there. There's no bang there anymore.
I got my hair cut this morning downstairs.
Looking very sharp.
Thank you, sir. We're from our barber, our famous Ali Barber. Right? And he said to me, he said, mate, I've given up looking in Sydney. It's just too expensive.
Yep.
I'm going to Perth.
Wow,
right? And, you know, Perth offers great affordability at the moment. You know what I mean? Like, Perth is a really good market. And, you know, a lot of people, he's not the only person, right? There are other people that are thinking like him going, you know what, stuff this. Sydney's just too expensive. I'm not going to be a slave for the rest of my life. I'm going somewhere else.
So it's just showing the flow of money, really just chase that flow of money. If he's going interstate, that means people are going interstate. There's
Chase the flow.
That's it.
Chase the flow.
What's the next one?
Number 5, probably one of the most important ones because it captures everything and it needs to yield. So basically we can tick number 1, 2, 3, 4. If it yields only say 2%, then we've got to start back again and go, okay, we've got to find something else. So we're really trying to shoot for a yield between 4 and 5%. Now, if you can tick all of those boxes from 1 to 5, right, you've got a really good investment.
Yeah, I think rental yield comes into play, and it's very important if we're growing our wealth, which is what we're doing. We're trying to grow. You see a lot of, in property investment, there used to be a lot of focus on negative gearing, where you'd park your money into something that's really expensive to buy into and run losses, actual cash losses, where you're losing money, but you're really banking on that capital growth to try and recoup that loss, where that's a bit risky if we're trying to grow our wealth.
You're hoping and praying.
We're hoping and praying. So for some people at the top of the sort of food chain in employment, where they're on $1 million, that makes sense. They can afford to fork out that money. It helps them tax-wise, but they're losing money at the same time, hoping for the growth. So when it comes to us trying to grow our wealth, rental yield is very important because we don't want to be parking too much or throwing too much money to these things. We want it to sort of pay itself off, if not just a minor loss, or get some tax benefits to help out, and really set and forget. We want a good asset that yields over time, that we don't have to throw money at.
Well, if we're borrowing money at 3%, for example, or 2.5%,
and yielding good,
nearly everything's yielding good. But let's say you're borrowing money at 2.5%, and you've got an investment that's returning a 5% rental yield, like. You're making money.
Yeah.
You know what I mean? So
it's
a no-brainer. You might as well do it. But if you've got something that's yielding, say, 2%, and you're borrowing money at 3%, you're losing 1%, right? So the rental yield's really important, because the rental yield allows us to hold on to that real estate and keep going. So if you're in positive cash flow, right, the banks are more inclined to give you more money to go number 2, number 3, number 4. So remember, this is the acquisition strategy. It's not just the one property, and this is where people fail. They look at the property that's been recommended in front of them and they go, oh, that's shit, I'm not going to buy that. I want to buy something which is just a cracker, right? And it's like, well, it's only one piece of the puzzle.
That's right.
Now, we need to do the reveal.
Oh, the reveal.
Number 6, our new fundamental. And this is thanks to you, Sam.
And what is it? It is depreciation benefits.
Tax breaks.
Essentially getting extra yield.
Yeah.
A hidden yield, let's say.
Yeah, a secret yield, a gift from the government.
It is. It's sort of like getting a JobKeeper payment if you weren't entitled to it, sort of thing. And we go through this with clients when we're looking at property. We actually do a tax effect calculation with them, which is what I help with sometimes. And what it's showing is that based on the numbers, they're going to differ per property, per apartment, per house. But really, the properties that are in the mix of choice for our clients are going to be generally positively geared from a cash point of view. So you're not losing too much money. But with depreciation on a new build, it's going to give you a loss with a tax refund at the end. And what that is money in your pocket. And if we take just a very basic example, which is achievable, and we have run numbers on these types of properties before. A 700k property, it could be 500k, but just to say 700k, if you're able to get a 7k tax refund, which is achievable on a brand new build, that's 1%. So you're getting 1% tax refund, adding to that 5% yield. If we're choosing through Luxland's fundamentals, you're getting a 6% yield on a residential property, which is sort of unheard of. You're getting into the commercial space.
That's like a commercial return, isn't it?
Commercial return. And you're clawing back that tax, which is money you're not getting access to. So if you do that a couple of times, you could be at a point where you're not paying much tax at all, which is helping you grow.
And this is how the rich don't pay tax. They own assets like this that tick all the fundamentals, and they're able to claw that tax back. And I think if you get number 1 to 6 right, and you do that 10 times, you're guaranteed success.
Well, the ones we're choosing for ourselves tick all these boxes, and we're realizing these things. So we're getting these tax breaks and the refunds, the extra 1%. So if you're looking to try and buy a decent property that's going to do these things, just talk to us.
Yeah, and follow the fundamentals. So we're going to move on, and we're going to just do a quick, role play, and we're going to talk about, an example really of someone who is, they're dual income. Mm-hmm. So it's a young couple, late 20s, early 30s, no kids, looking at wanting to build wealth. Both on $100,000 a year. So let's say have $100,000 in deposit. So good incomes, combined income of $200,000 a year, no kids or anything like that. Banks are willing to sort of give as much money as they want because they're quite young. Serviceability is high, great track record. What would we recommend them, right? If they wanted to build a 10-year acquisition strategy portfolio, what would we recommend?
Sounds like the world's their oyster.
Yeah.
Sounds like they could pretty much choose whatever they wanted. It would come back down to initially when we're dealing with the clients in that situation, we're looking at those key characteristics of their specific circumstance. It will come back to their price point and what they can invest in. Given their that data you just mentioned, would you say that nearly any asset type could be achieved?
It could, but I think the house and land would really suit them. I would say to those guys, go as hard as possible, because that's what's going to give them the growth to be able to build out this portfolio. Utilise the two incomes, right? Utilise your young age where banks are willing to give money to you, and try and get the best possible location for a house and land. Like, spend $1 million if you really have to, right? But let's say, you know, someone who is single, on a lower income of say 75, 80 grand a year, you know, has a limited deposit of maybe, you know, $80,000. You know, he lives at home with mum. You know, doesn't know when he's going to get the next pay increase, but he's got pre-approval to buy something for say 600 grand.
I think
right?
where most people run into the issue are these guys that have a certain cap on what they can borrow, and they might fall into the trap of buying the inferior house. So in that circumstance, he might see some house and land packages or some investments of actual homes and want to try and get in because of his lower price point. He's going to be putting into something that's not so great. So at that price point, you'd probably be looking at, say, the best of both worlds in a townhouse sort of area, I would say, giving you some of that land snippet, the potential growth over time, the demand from the homeowner, buyer coming into play in 5 years, and yeah, maximising that price point.
And I guess also what we need to remember is the townhouse will yield generally a better return. So for those people that are on low incomes, they can afford to hold that property better than generally the house and land. So those people that are on the lower incomes, they sort of need that yield because they need that servicing for their next one. So yes, it allows them to be exposed to really good real estate in a great location. So they're not missing out, right?
You're getting the best property you can for your money.
That's
so
right.
You're not putting in a house and land that's not good, you're putting in a good asset.
That's right. So the next step after that, right, after listening to all of this, after going through the whole presentation,
The hardest thing to do
is to not be a bitch.
In nice words, take action. It's the biggest stumbling block. How many times does it happen when you're dealing with clients that you go through everything? They're even in a position to do it. They have the money. They got 300 grand from somewhere. We don't know where. They won't tell us, but they got the money. But they won't put the money into the deal. So I see it a lot through our meetings with clients that, you know, everything makes sense for them to do it, but it's getting the balls to actually sign a contract, which is hard to do. It's hard to do. My first one was very hard.
The first one's always the hardest, right? But a lot of people fail to do it at all. Yeah. And this goes back to the statistics of property investors and the reason why only 2 million people are property investors in this country. Mm-hmm. Now, to me, in this current environment, with the way superannuation is and the way our savings rate is, our interest rates, if you don't hold property with leveraged money, you're going to miss out. Right, so you need to join that 2 million people. Like we need to turn that into 3 million, 4 million, 5 million, because, you know, like even if you don't have this vision of having 6 or more properties, right, and you don't want to join the 1% club because it's too hard. At least join the 2 million. You know, stop being a bitch. You know, sign the contract, do it, transfer the money, convert your dollars to bricks and mortar. You know what's funny? I listened to a podcast during the week. I can't remember who it was, but it was about inflation and about our money buying less. Right now, I'm currently seeing it in the construction industry, where construction costs are just massive, going through the roof. Something that was costing me, say, $380,000 to build last year is now costing me $420,000, $430,000. Wow. Right? Materials are going up. There's a shortage on skilled workers like labourers and, you know, that type of stuff. And what's happening is it's pushing prices up. Now, our measuring stick for money is it's inaccurate now, because what's happening is people are going, oh, things are costing much more. But what they should be doing is converting that currency to bricks and mortar. Because if they had their money in property, as in bricks and mortar, that bricks and mortar is rising in value. Then if you use that as a measuring stick, then you're like, well, wow, I'm making money, right? Because money now is becoming worthless and we need to convert it. And these people, like you said, Sam, they've got $200,000-300,000 in the bank. What are they doing?
Yeah, 100%. Just touching on that, if building costs are going up, that means the property is going to be more expensive. It costs more to build it.
That's
you
right.
know what I mean? So by default, it's going up. I think learn from us. What's our, one of my biggest mistakes in property is not getting in early enough. So if you're not going to act now, when are you going to do it? We're always talking about get in as early as you can. My big regret, which the listeners have heard before, is not buying something 10 years ago that's tripled nearly in value. My biggest regret, because I'd be so much further ahead of where I am now.
You talk to anyone who's bought property before.
It's always, I should have done it earlier.
I should have bought more. I should have done more. It's always the case.
So if you're thinking in this space and you come and talk to us, we're going to try our best to get you in because we know it's good for you.
Start the acquisition strategy very, very early as possible. So there you have it, guys. That's our 10-year acquisition strategy from start to finish.
Amazing.
And look, we would love to help you out on that journey, and that's what we're here for, aren't we, Sam?
Yeah, that's it.
So thanks for listening today, and thanks for co-hosting as per usual, Sam. I really enjoyed it. You're a wealth of knowledge.
Oh, and you are as well.
Oh, thank you. All right, until next time. I'll see you soon. See you guys. Bye.
See ya.